With global central banks printing trillions of dollars in new currency these days, those voices claiming that cash is trash, appear to have a pretty valid point. Banks give us no return on cash savings, and inflation is swiftly eating away at its purchasing power. So what's the future outlook for the world's major fiat currencies? And are there better stores of value we should consider instead of paper cash? We invited economic analyst Lyn Alden to answer those very questions for us at the recent Wealthion online conference held in early June. If you missed that conference, well, you're in luck, as we're making Lyn's excellent interview available to you right now.
Over time, we're moving more and more towards kind of a multipolar currency system where I don't think there's any one currency that comes in and displaces the dollar. I just think that the dollar goes down as a share of global reserves and as a share of say commodity payments, for example. And it could even still be the single biggest, but that it's just not. It doesn't have like a complete lock on those markets like it has for quite a while.
All right, I'm very excited for this next guest who a number of the Wealthion audience has asked to have on the program and to hear from. I'm talking, of course, about Lyn Alden. Lyn is an experienced investment researcher who applies her strong engineering background to the world of finance. And at her blog, lynalden.com, and through her many media appearances, Lyn provides tens of thousands of investors every month with research, information, and tools to help them build wealth and reach financial freedom. I'm so glad she arranged to join us for this conference. Lyn, thank you so much for joining.
Hey, I'm happy to be here. Thanks for having me.
You're welcome. And we got a little bit less time than we do on the normal programs, Lyn, so I'm just going to jump right into it if that's okay.
Sure.
Let's get into, I want to start by talking about the dollar with you. You've written a lot recently about the dollar as a US dollar as a reserve currency. You've written about its role as the petrodollar. And I think you cover a lot of asset classes that people look into as either substitutes or a defense against a weakening dollar. So let's jump right in there. The dollar has been in a prolonged decline since the trillions in stimulus have been issued in response to the coronavirus pandemic. And interestingly, at this point, further weakness appears to be an expectation that pretty much nearly everybody on Wall Street seems to share today. Do you expect its decline to continue? Is this just a slam dunk bet?
Well, I think nothing's a slam dunk bet, but my base case is over the next 3 years or so to see continued dollar weakness from here. I do think that we're probably on the down leg of a significant, if you look at back at the last 50 years, we've had this giant kind of like 15-year gyration in terms of these big multi-year bull markets and then bear markets in the dollar. And I do think this is likely, most signs point to it being kind of the third major bear leg of that long-term cycle. But there are curveballs that can throw that off course for a couple quarters. And so as an example, I turned bearish on the dollar back in late 2019. And started to weaken, as planned. But then, of course, the coronavirus came around, and all the different effects out there in the economy, result in that shortage that pushed it up. And so it's one of those things where the lower probability event became kind of a temporary, that would actually happen until, of course, we got past that and then continued with the down leg of the dollar. And so overall, I do have a longer term outlook that is pretty negative for the dollar. But whenever it gets to consensus, that's when you get a bounce. And so, for example, when we went into this year 2021, that's when positioning was really negative on the dollar, and so we got that kind of 3 month bounce to clear out some of that consensus. And lately, we've been going back down again, and really what I'm watching to see is if it breaks a couple of the key support levels, kind of breaks the previous low that it set in the beginning of this year. Compared to a number of currency pairs. It already has for a few. And then next, I'm watching to see if it breaks past the early 2018 bottom that it had against some other currencies.
All right, can you just give a quick summary then? So you said you went bearish on the dollar all before coronavirus hit the world. Can you just give a quick summation about why you predicted a lower dollar even before we had all these fresh trillions in stimulus?
Sure. Mainly, it's the combination of loose fiscal policy combined with loose monetary policy, and it's one of those. It's one of those things where there's a couple kind of nuances there that can be pretty tricky. And so, when you have pretty loose fiscal policy with tight monetary policy, that tends to be dollar bullish. And so, for example, in the early '80s, under Reagan, when he was running, pretty kind of larger fiscal deficits, but then you had Paul Volcker running pretty tight monetary policy. That was really bullish for the dollar. Same thing for the 2018 period, where we were running larger fiscal deficits in the United States compared to most other developed countries as a percentage of GDP. But we were doing quantitative tightening, we were hiking rates, and even though we were still dovish in the historical sense, we were tighter than most of our developed peers, and so that was a recipe for a pretty strong dollar. But when you have the combination of loose fiscal policy, meaning that the United States is running larger fiscal deficits than the rest of the developed world, and when you then shift from tight monetary policy to loose monetary policy, as we saw happen after the repo spike, that was my trigger to turn more dollar bearish in late 2019. That's the kind of the shift for that release valve to start going down and for the dollar to weaken. And then if you take an even further step back, because the United States runs these structural trade deficits, our natural tendency for the dollar is to weaken over time, but it gets held up by these really big kind of offshore US debt cycles that happen, and that creates a lot of demand for it. And so we have these giant gyrations that are really based around the shifting monetary policy that's happening. And so that kind of sets like the big stage for why it happens. But then I have to kind of watch the quarter to quarter action to see if we're getting price confirmation and what other variables can cause kind of multi-quarter or multi-year deviations from that big structural trend.
Okay, yep. So you're seeing this big structural sort of secular trend, but you got to watch out for the cyclical patterns that can happen within it.
Exactly.
Let me ask you, where I'm kind of going to a couple places with these questions, this line of questioning, but one of them is, if the dollar just continues to weaken, right? It is the world's reserve currency that does give the U.S. an exorbitant privilege, and there are many people out there that are saying, look, don't take its continued weakness forever as a given. The United States is going to step in at some point and do whatever it can to protect that exorbitant privilege. What do you say to people that make statements like that?
Well, I think it's so taking a step back. I think it's when this current dollar structure was put into place in the 70s, that did give the United States a pretty exorbitant privilege. But over time, basically the benefits were pretty static, meaning we got a continued benefit from that. But the downside from that, the cost of that system kept growing and growing and growing, mainly in the form of a structural trade deficit, which really materialized because of the structure of this current system, the petrodollar system.
Right,
And
and
so
I'm sorry to interrupt, but isn't that even sort of what Triffin's paradox says, that if you're the reserve currency, by definition, you have to run a trade deficit?
Well, in a way, so there's a couple different versions of the Triffin dilemma, and so the initial version is more about the capital account. That was kind of the gold standard version of it, the Bretton Woods portion. But then when we transitioned to the petrodollar system in the 70s, after the Bretton Woods system broke down, then it became a current account problem. And so basically the way it currently works, yes, we essentially have to run a current account deficit in order to maintain it. And it's one of those things where the top 5 or 10% of Americans do very, very well under that system. So if you work in finance, healthcare, near DC, or healthcare, some of these kind of like more higher margin type of work, you can do very well because you're benefiting from higher incomes, you're benefiting from your currencies accepted around the world. You have a lot of purchasing power when you travel, when you consume, when you basically consume from the rest of the world. But if you are basically in the lower 2/3 of the income spectrum, especially if you're involved in anything that makes things, and that basically would benefit from a different system, you're harmed by it, because even though you have some of the benefits of it, you're also getting the full burden of the cost. And so that's this contributed to why the United States has a larger wealth concentration than most other developed countries. Why our politics can be somewhat polarized, why certain regions flourish and other ones became like the Rust Belt. A lot of this is tied into the structure. And so, I think some of the smartest analysts out there, like you've had Luke Groman on your show, I think he does wonderful work in that area, showing that in many ways that the way that the system's currently structured is actually starting to cause more harm for more Americans than the benefits that are outweighing it. And so, this might have made sense decades ago, but in recent decades, it's really kind of been used against us in many ways. And so I think that there are some groups that are trying to defend the current system, whereas other groups are increasingly realizing that it's really, if anything, it's serving China a lot better than it's serving the United States.
Wow. All right. So then this gets really fascinating, which raises the question. Okay, so how is that power dynamic going to play out? Um, who's more likely to win? What does that sort of back and forth look like as the two factions wrestle for control? Um, I'll say the pessimist in me says that the people who kind of have all the power in the current system, I think, are the ones that benefit from it in the ways that you said. So I don't see them giving up that power lightly. I'm just curious, and this is a really big question, but I guess, how do you see that playing out in the future?
Well, I think so. We're starting to see it play out, since 2020, in the sense where the Fed has basically realized that they're kind of backed in their corner, where now they're at the point where they want to let inflation run hot, but they also want to hold yields low. And so, in many ways, I've been using the fact that this looks a lot like the 1940s in that sense, in terms of fiscal monetary policy, where you have basically fiscal-driven inflation combined with the Fed, who's mainly just accommodating that fiscal expenditure. So they're buying the amount of treasuries that are needed to kind of keep that liquid. They're holding rates below the inflation rate, and basically, so if you look at it, the United States has lower real yields on the front end of the curve than a lot of our developed peers, and so they are contributing to a weaker dollar here. I think their game plan is to have it be a orderly decline and basically a down cycle without any sort of structural changes. And we've seen this kind of playing out, politically, because sometimes you have different groups kind of working against each other. And so, for example, when Trump was in office, he was often complaining that Powell's monetary policy was working against his fiscal policy. And a similar thing where you might have some factions in the government that are in favor of, basically changing the system, whereas other ones are then kind of, emphasizing putting sanctions on the Nord Stream 2 pipeline, for example, and trying to keep the current system in place. And so we've seen kind of flip-flopped, political actions. And I don't think this has like a really kind of neat outcome. I think it's kind of it's moving on regardless of whether or not policymakers want it. And I think the way that the math works, it's almost inevitable that we're shifting at least gradually out of the system. But then there could be kind of say multi-quarter periods where they fight it until it causes basically something to break, like the treasury market turns to liquid, like we saw, during the March 2020 period, or you have a problem like the 2019 repo spike. And so these events basically keep kind of forcing policymakers in one direction anyway, and there's little they can do about it except for arguing about the timing and kind of the details of how they want to do it.
All right, Lyn, I feel like we could talk about this single topic like for the entire conference. It's so fascinating, and it's so unfair to ask you to kind of try to come up with really pithy conclusions here in the little bit of time that we have. But let me ask you this: do you see this sort of you know wrestling for a different solution ending in the end of the US dollar as the world fiat currency at some time in the future?
In a sense, but not the way that most people will probably interpret it. And so a lot of people think in terms of you either have it or you don't, and that if one country loses it, another country has to gain it. Where I view it more as a spectrum. And so if anything, the current version of it, like the 1970s and since version of that, is actually different than the previous global reserve currencies before it. It's the first time where, basically a country set itself up to run these persistent structural current trade deficits, current account deficits with the rest of the world on a multi-decade basis, to try to have their currency be this, widely accepted, and then specifically the only currency that you can use to buy essential commodities. That's kind of a unique thing for this particular cycle, this 50-year cycle, this kind of structure. And so over time, we're moving more and more towards kind of a multipolar currency system where I don't think there's any one currency that comes in and displaces the dollar. I just think that the dollar goes down as a share of global reserves and as a share of say commodity payments, for example. And it could even still be the single biggest, but that it's just not, it doesn't have like a complete lock on those markets like it has for quite a while. And in many ways, we've already seen, for example, the dollar share of global reserves has been in decline for the past 20 years, very slowly. And then the big thing to watch that's more recent, that just the past couple years, is that we're starting to see oil trade happen outside of the dollar-based system, led in part by Russia and a couple other nations. And so that's kind of a more structural shift, where I think we're heading towards kind of a period of regional reserve currencies rather than say the U.S. dollar just kind of like a light switch going off and we lose that status and another country gets the status. I think basically we're at the point now where there's no country whose currency is big enough to be the only currency that you buy oil with.
Got it. Got it. And I hate to ask this question, but in regards to oil, and you're referring to the petrodollar. Is there a point at which the U.S. military machine gets called in to just say, "Hey, look, that's been such a great advantage for us. We really want to stop the competition or curtail it"?
Well, I think it depends how smart they are. And so it's funny because, we did that in the past. Basically, some have argued that some of our military inventions were based on, basically maintaining the system. But when you have a nuclear power like Russia selling oil outside of the dollar-based system, there's little you can do about that militarily. They've been doing sanctions and things like that, for kind of related reasons, not necessarily citing that reason. Just, basically, we're unlikely to do, say, kinetic military action against that sort of, situation. Now, if they are smart, they basically would realize that the way that it's currently structured is that the United States military is doing a really good job of making sure that China is able to access all the oil they want. And so basically, it's one of those things where the cost has gone up and up and over time, whereas who's benefiting the most from the system is actually shifted away from the United States. And so right now, it's basically, we are paying for the system, but it's not necessarily benefiting us in the same way that it did decades ago.
All right. Like I said, super fascinating. I would love to tug on that thread further. I'm going to have to reserve tugging on it the next time we have you on the program, but just fantastic and really fascinating insights, Lyn. Thanks. I want to pivot now to sort of why I started with the dollar here. Many of the people who are viewing this video, they are concerned about the future purchasing power of fiat currencies. And most of them are Americans, so I'm sure they care most about the dollar, but we do have people from all over the world watching, and they have concerns about their own home currencies. Do you share those concerns? And if so, where do you think capital is going to be better treated than just being held in the cash of those fiat currencies?
Yeah, so the answer to the first part is yes. I do think that fiat currencies are not very attractive in this current environment. So Ray Dalio, for example, referred to cash as trash, and I think that's it's a colorful way of saying that basically you're getting little to no interest rates, in some cases negative interest rates, to hold cash, and yet the inflation rate is in most countries positive, in some cases strongly positive, and so you're not keeping up with the rise in prices. And so if you're holding cash in a bank, probably 5 years from now you're going to have notably less purchasing power, even if there's no major inflation spike or major kind of reset or something like that. Just the sheer kind of losing points every year is a big issue. And that's actually already been happening over the past decade, where most of the past decade you did not get positive real yields by holding either T-bills or cash in a bank. And it's kind of accelerating here in the 2020s. And so I do think that overall, fiat currencies are not a good store of value, especially in this current environment. And where capital is better treated, I think that it depends on what country you're in and what you're mainly interested in investing in. But I think that there are a variety of equities, in the commodity space or in some of the value sectors that are pretty attractive at the current time. I think there are assets like precious metals or farmland that are attractive. I've been using Bitcoin as a diversifier. They're basically, there are pockets of value around the world, and every couple quarters, generally, you have one of these kind of open up. Either you have a correction or some sort of cyclical event happens, and it basically allows kind of an accumulation event to happen until that becomes more consensus, and then you kind of look for kind of what else got cheap.
Okay, great. So I want to dial through a couple asset classes quickly, if that's okay. I want to preface all this by saying there are a lot of people out there, and I'll put myself in the camp, that look at really the response to asset prices response to the intervention by the world central banks, not just since the pandemic, but really since the great financial crisis, where at this point, many assets are at all-time record high levels of valuation, and the term "the everything bubble," has been put out there, which that almost every asset class is now in an asset price bubble. And so you mentioned there about every so often there's a correction, you can rotate, into the group that's corrected and get in at some better prices. I think a lot of people right now kind of have the worry that, oh my God, almost everything is overpriced and in danger of a really painful correction here. So with that background, and I give that because if you think differently, feel free to opine on that. But let's move to equities, because I think there we can make a pretty strong case that there's a lot of equities that are at all-time level, not just prices, but valuation metrics, whether you're looking at PEs, price to sales, Buffett ratio, whatever. So I guess, how concerned are you about those levels of valuation in equities right now? Are you concerned about money that's put into the market long these days at an undue risk of like a 50% type of market correction that folks like Jeremy Grantham are warning about? Or do you think that those fears may be overblown?
I think there are significant, there is a foundation for those concerns. And so overall, my base case would probably look more like, after the late 60s when we had very high equity valuations and we entered a more inflationary period, you had a really choppy sideways market. It basically had a ton of volatility. You had significant drawdowns. You had poor returns. You had very poor inflation adjusted returns. And so overall, I'm kind of looking at that as kind of the lower end case for how this likely goes, where I think that with, basically the way it's currently structured, I don't think you're going to have, like, say, a 1929 style crash, because that, in that environment, the dollar is pegged to gold. So basically what you're doing is you're pricing the S&P 500 or the Dow in gold, and that's going down significantly and staying down for a very long period of time. Whereas if you're pricing something in a denominator that itself is losing value, it's a little bit more fluid. It basically can soften some of those giant crashes. But overall, if you look at the S&P 500, by most metrics, we are either the most expensive we've been in terms of, say, the Buffett ratio, the market capitalization to GDP, whereas other metrics show that we're like the second most expensive we've ever been in terms of, say, the CAPE ratio. Basically, we're second to the dot-com bubble. And there's 5 to 10 indicators that you can look at, and most of them say number 1 or number 2. And so that's obviously a really big challenge for the forward returns of stocks. Now, a complicating factor is the fact that bond yields are also super low. And so, for example, if you look at the dot-com bubble, the equity risk premium was very, very low, meaning that it was almost a no-brainer to buy treasuries instead that were yielding like 6% and had a positive real return compared to buying equities. The challenge in this environment is, if you look at, say, the past century of data, stocks are still kind of in a place where they could do equal or better returns potentially over the next 10 years than 10-year treasuries. And so investors kind of have that challenge where they're both bonds and stocks are very expensive in absolute terms. And because those are the major kind of liquid investment classes, a lot of people kind of looking at those two and say, well, I'd still rather own a significant chunk of equities. I think if you look under the hood, so if you look at, say, certain sectors that are not in favor, a lot of those are actually, either averagely priced or in some cases underpriced compared to their historical average. And so, the everything bubble is in many ways more of an interest rate bubble that then caused a duration bubble. And so long duration assets like growth stocks are at extremely high valuations because they're using an extremely low discount rate that might or may not persist. Whereas if you look at equities that they basically have more of their cash flows in the near term, the next few years, like value stocks, like banks or energy companies or healthcare companies or pipeline companies, things like that. Those are actually in many cases either trading at valuations that are in line with the past 30 years, or in some cases they're pretty cheap. And so you have some, like, for example, the energy sector that's been in like a 13-year bear market. And so I do think that there are pockets of value both in certain sectors, and if you look at internationally, if you look at, say, certain Russian stocks, if you look at certain Japanese value equities that have global exposure, or if you look at some of the things in Southeast Asia, for example, I do think there are pockets of value out there that someone can basically piece enough of those together to have a diversified portfolio that limits the probability of a say a 50% correction or other kind of permanent loss of capital.
All right, great. And preceding your presentation here, Lyn, we had Grant Williams on earlier today, and he talked about we're entering a new era where active management is going to become much more back into vogue because the sort of set it and forget it passive management that's been dominating over the past 10 years is no longer going to work nearly as well. I kind of get the sense that maybe that's sort of, you might be similarly minded here, which is, hey, you can't just sort of buy a sector, buy an index anymore and just set it and forget it. You got to really start doing your homework like investors of old had to do and get in there and look for those sectors, those companies that are, trading on the cheap, but may have a cyclical upside ahead of them. Is that true?
More or less, yeah. I think there are ways to play it with some ETFs. Like there are equally weighted S&P 500 ETFs, or there are certain value ETFs or sector ETFs. Someone can play it, but overall, I do like this period for individual stocks, as well as basically being in certain asset classes that are not these big giant consensus duration plays like the S&P 500. So in the past decade, when you had interest rates go down, you had valuations continually go up. You had growth outperform value, and in the market cap weighted indices, those growth stocks became the majority of the index, and then kept inflating from there. And so basically, it's very, very hard to keep up with the market cap weighted S&P 500, or even better, the Nasdaq. But now that we're kind of basically seeing early signs of a growth to value rotation ever since about summer or autumn of 2020. If that were to persist, then my base case is that it won't do it in a straight line, but my base case is that it would persist for a number of years. There's probably a pretty durable trend that generally investors that are more actively positioned, or at least that are in these other asset classes and letting those ride, are likely to do better than, to say, a pure S&P 500 or pure Nasdaq exposure.
Okay, great. Well, let's move on quickly to commodities. We hope you've been enjoying this excellent discussion with Lyn Alden. The interview continues over in part 2, where Lyn shares her guidance on which asset classes appear prudent given the highly uncertain environment now facing today's investors. To watch part 2, just click on the link provided in the description of this video below, or head over to youtube.com/Wealthion. Oh, but before you go, please don't forget to click the subscribe button below if you haven't already, as well as that little bell icon right next to it. Oh, and if you'd appreciate a free, no strings attached financial portfolio review by a professional advisor who takes into consideration the macro risks and opportunities mentioned by Lyn, just head over to Wealthion.com and we'll set one up for you. Okay, I'll see you over at part 2 of our interview with Lyn Alden.